to the March edition of This Month in Payroll for 2026. I'm Alana Hayduck, a partner in PwC's Payroll Advisory Practice. This month we will focus on year-end payroll, inbound and outbound assignees, deductions, overpayments and termination pay, and employment termination payments and rate of pay. Let's get into our topics for today. Year-end payroll, inbound and outbound assignees is our first topic. This month's year-end topic is inbound and outbound assignees and reporting via single-touch payroll. Let's first consider inbound assignees. An inbound assignee refers to an employee on assignment to Australia from an overseas affiliate, typically someone employed by an offshore entity who is seconded to work in Australia, often with some or all of their salary paid by the offshore employer. Under single-touch payroll, every payment must be assigned an income type that tells the Australian Taxation Office how the income is characterised. For an inbound assignee, the relevant income type depends on the nature of their arrangement. Salary and wages is the default income type for most employees. This income type is used for an inbound assignee if they are being paid and reported like a regular employee through an Australian payroll. The inbound assignee to Australia, or IAA code, is used when the employer is using the single-touch payroll reporting concession for inbound assignees. This income type signals that the employee's payments are being reported under a shadow payroll arrangement with deferred reporting. When using the IAA code, you must also report the employee's home country, that is, the country of the payroll that pays the employee. The Working Holiday Maker, or WHM code, is used if the inbound employee is on a working holiday visa. Earnings reporting under this code are taxed at special non-resident rates, and you as the employer must also register as a Working Holiday Maker employer. Finally, the Seasonal Worker Program, or SWP code, is used if the person is working in Australia under an eligible seasonal worker or Pacific Labour Mobility Scheme and has notified you they are a non-resident for tax purposes. Determining who should lodge the single-touch payroll report depends on the employment and payroll arrangement. If the home company has no Australian presence and is not entitled to an Australian business number, the overseas employer may be entitled to a withholding payer number, or WPN. A WPN will enable the employer to satisfy their Australian employer obligations. Where an employer has a WPN, they are generally not required to report through single-touch payroll. In such cases, the employer will report any pay-as-you-go withholding via an annual payment summary report and provide a payment summary to the employee at year-end. If there is an Australian host entity, for example, an Australian affiliate or branch to which the individual is seconded, that entity should generally lodge the single-touch payroll report for the inbound assignee. Typically, the host will set up a shadow payroll to calculate the Australian tax and superannuation for the assignee. The Australian host entity will report the assignee's income and withholding via single-touch payroll under the host entity's Australian business number, even if the salary is actually paid by the offshore employer. If the assignee is transferred to the Australian entity's payroll or hired by the Australian company, then the Australian company as the employer would lodge the single-touch payroll for the employee in a normal way, like a local employee. The wages that are paid and are reported in real time through the local payroll, so there is no concessional treatment being used to report the assignee. If the assignee's remuneration is split between home and host, for example, part of the salary is paid overseas and other allowances or top-ups are paid by the host in Australia, then all payments are generally subject to Australian tax and should be reported via single-touch payroll. Similar to inbound assignees, employers must ensure accurate payroll data compliance with correct income classifications and proper handling of allowances, benefits, superannuation and tax residency for employees sent by Australian organisations to work overseas. Outbound assignees are employees temporarily sent overseas by their Australian employer. Assignments range from short-term business trips to extended secondments and may involve various payroll arrangements, home country payroll, host country payroll, or even shadow payrolls. Employers must track tax withholding, superannuation, and compensation for these employees, regardless of where the day-to-day payroll is processed. If you have Australian employees working overseas, you need to determine whether their earnings should be classified as foreign employment income, or FEI, in your single touch payroll reports. Generally, if the employee is an Australian tax resident and they are working in a foreign country for an extended period, their earnings from the Foreign Service should be identified separately. You should report an employee's income as foreign employment income via single touch payroll if any of the following apply. Firstly, you as the employer have had to withhold and pay foreign income tax to a foreign government on the employee's behalf. Secondly, the employee is working in a foreign country for a continuous period of 60 days or more. Or finally, the earnings are from a foreign source. Under single touch payroll, to report foreign employment income, you use the FEI income type and include the host country code for the employee's payments. As an employer, you should consider whether you have any single touch payroll reporting obligations for short-term or long-term assignees, either to Australia or from Australia. Reporting correctly assists an employee with completing their individual income tax return, as well as ensuring appropriate foreign income tax offsets can be claimed. Over to topic 2 now, deductions, overpayments and termination pay. Before an employer deducts an amount from an employee, either upon termination or during employment, it is important to consider if the deduction is allowed under the legislation. Under the Fair Work Act, an employer can only deduct money if the employee agrees in writing and it's mainly for the employee's benefit, it's allowed by law, court order, or a Fair Work Commission order, or finally, it's allowed under the employee's award or enterprise agreement. Employees can authorise in writing one-off or regular pay deductions that are mainly for their benefit, such as health fund payments, voluntary contributions to superannuation funds, or union fees. Deductions must have a genuine, voluntary written consent, which can be withdrawn at any time. The written agreement must detail the amount, reason, date, recipient, and for regular deductions, the frequency and whether amounts may change. All deductions must be properly recorded in an employee's record and shown on payslips, with changes to specific deduction amounts requiring new written authorisations. Beyond those types of circumstances, employers can only deduct from employees' pay in very limited circumstances. It is important to consider the deduction rules where there is an overpayment, especially when an employee is terminating. You should consider the following process. Confirm the overpayment and ensure accuracy. Check relevant awards, enterprise agreements and contracts for any deduction clauses. Calculate both the overpayment and final entitlements. Assess the legal viability of any deduction and seek written consent if appropriate. For complex or disputed cases, seek legal advice. Where a deduction is not possible, pay full entitlements and consider separate recovery, such as negotiation or legal action. And finally, record all steps and communications. Now on to topic 3, employment termination payments and rate of pay. When an employee's employment comes to an end, it is important for both employers and employees to understand the entitlements that must be paid out and the rate at which those entitlements must be paid, noting that applicable contracts and industrial instruments may provide more generous entitlements. I'm going to step through the minimum entitlements. Where an employee works during the notice period, the employee must be paid their full normal pay, including regular allowances and loadings. Public holidays during this time are paid but do not extend the notice period. Employers cannot exclude ordinary work benefits. Where there is a redundancy, statutory redundancy pay is paid at the employee's base rate for ordinary hours, excluding overtime, penalties, allowances, loadings, and bonuses, and it's usually based on the length of service. Accrued annual leave is paid out at the same rate as if taken, including leave loading where applicable. It is essential to consider regular reoccurring allowances or other payments, as these may need to be included in the rate. That is, if an employee takes annual leave, do you continue to pay those allowances? If so, then these allowances may need to be included in the rate of pay for annual leave payout, as that is the amount that would have been payable if the employee had taken their leave. Long service leave is generally paid at the current ordinary rate or the higher average if pay or hours fluctuate. You should consult relevant state legislation as service thresholds, accrual rates, and averaging periods vary by jurisdiction. As an example, New South Wales legislation provides for two different types of ordinary pay: a worker's ordinary remuneration or a worker's average weekly wage. The type of ordinary pay that applies depends on how the worker is remunerated under the terms of their employment. The first type of employment applies where a worker is paid at a fixed rate of pay, such as workers who are paid salary tied to standard days and hours worked, or workers paid an hourly rate tied to hours work, including workers with variable hours like casual workers. In these cases, ordinary pay is worked out as the higher of the worker's ordinary remuneration at the prescribed date, or the worker's average weekly ordinary remuneration over the previous 5 years. The second employment type applies where a worker is not paid at a fixed rate of pay for ordinary hours worked. For example, workers who are paid by commission or output, workers who are paid multiple rates of pay for different tasks, or workers who are eligible for or entitled to be paid bonuses or incentives. In these cases, ordinary pay is worked out as the higher of the worker's average weekly wage over the previous 12 months, or the worker's average weekly wage over the previous 5 years, ending on the prescribed date. Allowances are included in ordinary pay for long service leave if they are paid as part of a worker's regular wages for their service. Allowances that are expense related, including reimbursements for expenses, are excluded from the ordinary pay calculations. Bonus and incentive payments are included in the worker's ordinary pay if they meet the definition of a bonus or incentive under the Act. That is, it is provided for under the terms of the worker's employment, it is part of an established bonus or incentive scheme, it depends on performance or results, and it is not the worker's main form of remuneration. If these conditions are met, the payment is included in ordinary pay, subject to the high income threshold rules. Bonuses and incentive payments are only included in the worker's ordinary pay if the worker's annual ordinary pay, calculated without any incentives and bonuses, is below the high income threshold, which is currently $183,100. The New South Wales Industrial Relations has recently launched new long service leave guidance. As of the 1st of March 2026, updated guidance has been issued to assist employers with administering their long service leave obligations. And that's it for our March edition of This Month in Payroll. If you would like to revisit any of our prior updates, they are available on our website at pwc.com.au/payroll. And if you have any questions or need support, please reach out to myself or your usual PwC contact. Until next time, have a great month in payroll.